What if I told you that one of the largest financial shell games in modern history just happened right under our noses, and almost nobody noticed? Stay with me, because in the next 15 minutes, I'm going to show you exactly how $688 billion quietly changed hands, and why this could trigger the next major financial crisis. I'm talking about real money, real risk, and real consequences that could hit your portfolio harder than you think. If you care about protecting your wealth, you need to hear this. And listen, if you find value in what I'm breaking down today, hit that subscribe button right now. We're Capital Pressure, and we dig into the financial stories that Wall Street doesn't want you to understand. Let's get into it. For the past 12 months, the financial media has been feeding us a very specific story. They've told us the American economy is unstoppable. They've said that demand for United States government debt is strong and organic. They have reassured us that geopolitical tensions with China are manageable risks that won't shake the foundation of global finance. But here's the problem with that narrative. When you actually look at the hard data, when you examine the Treasury International Capital reports that just came out, you see something completely different. You see a market that isn't running on pure strength. You see a market that appears to be propped up by hidden players who stepped in to prevent a complete meltdown. Before we go any further, I need to clarify something critical about how this data works. The Treasury International Capital system doesn't track who actually wants to own these bonds or why they're buying them. It only tracks custody, meaning it shows where the bonds are physically held. This is a massive distinction because it means enormous transfers of ownership can happen without the market ever realizing what's really going on. The prices don't immediately reflect the truth because the truth is buried in custodial accounts. Now, let me take you back to what we already know. China has been systematically dumping massive quantities of American Treasury bonds. This isn't speculation. This is documented in the official data. We're not talking about a small portfolio adjustment here. We're talking about a coordinated, strategic exit that looks like preparation for something much bigger. The scale of this sell-off suggests they're cleaning up their balance sheet, getting ready for potential conflict. Why would they do this? Because they watched what happened to Russia in 2022. When Russia invaded Ukraine, Western nations froze hundreds of billions of dollars in Russian assets overnight. China learned that lesson. They realized that if tensions escalate, their treasury holdings could be weaponized against them. So they sold. They sold aggressively. And they took that money and bought hard assets. Gold reserves went up. Strategic commodities like oil went up. They shifted from paper promises to physical wealth. But here's the question that's been haunting bond traders on Wall Street. The question they whisper about in private but never discuss on CNBC. If the second largest holder of American debt just dumped $600 billion worth of bonds onto the market, why didn't the whole system collapse? Think about basic economics for a second. The Treasury market is the biggest, most liquid market on the planet, but it's not invincible. When a massive seller floods the market with supply, prices are supposed to drop. When bond prices fall, yields go up. And when yields go up, that means interest rates across the entire economy rise. If normal market forces were at play, China's exit should have been catastrophic. Let me paint you a picture of what should have happened. Financial models suggest that the 10-year Treasury yield could have shot past 6 or even 7% during this liquidation period. Mortgage rates could have spiked into double digits, crushing the housing market. Regional banks, which are already sitting on hundreds of billions in unrealized losses, could have faced a full-blown crisis. History backs this up. When Japan drew down reserves in the late 1990s, Treasury yields moved violently. When China reduced holdings back in 2015, yields jumped even though the Federal Reserve was actively trying to keep them down. In March 2020, even modest selling caused the Treasury market to malfunction completely. So by comparison, staying relatively calm during a $600 billion liquidation is absolutely abnormal. But that nightmare scenario didn't happen. Yes, yields rose. Yes, they've stayed stubbornly high. Yes, Treasury auctions have been messy. But the system didn't break. Primary dealers absorbed the supply. The crisis was contained. Volatility was managed. So how? How did the United States Treasury market swallow a $600 billion wave of selling without triggering a systemic collapse? The data strongly suggests they didn't rely on the free market alone. A truly open market would have demanded much higher compensation for that risk. Instead, what we see is a shadow network of strategic buyers who stepped in as the emergency backstop. We need to shift our focus from the seller to the buyers. When you analyze where these bonds actually went, the picture gets really interesting. They didn't go to regular American investors. They didn't go to regional banks who are already stretched thin. They didn't even go directly to the Federal Reserve, which is supposedly still tightening. So where did $600 billion in Treasury bonds disappear to? The flow of funds points to two specific groups. First, geopolitical allies who are essentially doing America a favor. Second, highly leveraged speculators who saw an opportunity to make money off the chaos This looks like a coordinated operation to swap out a hostile creditor for controllable ones. Make sure you're subscribed because we're about to get into who these hidden buyers actually are. And trust me, you need to understand this. Drop a comment below if you're following along so far. Let's keep going. The United States financial system essentially replaced China, a hostile actor, with two types of buyers. Friendly allies who will hold the debt for political reasons, and hedge funds who will hold it for profit. This kept yields from exploding, but it fundamentally changed who America owes money to. We've moved from a market backed by countries with massive trade surpluses and stable long-term capital to a market backed by political alignment and leverage. The debt didn't disappear. It didn't get paid off. It just moved from strong hands that held it for decades to weak hands that might panic and sell at the first sign of trouble. Let me show you the actual numbers from the latest Treasury International Capital data. China's holdings have dropped to a new low of $688.7 billion. That's down from a peak of over 1.3 trillion. They've liquidated roughly 600 billion, which is more than the entire economy of Sweden or Poland. The capital had to come from somewhere. Someone had to write the checks to give China their exit. And I'm about to show you exactly who those someones are and why they might not be able to hold these positions for long. Let's start with the United Kingdom. Recent data shows the UK now holds approximately $878 billion in American treasuries. That makes them the number 2 foreign holder, surpassing China. But here's where this gets strange. The United Kingdom is running both a budget deficit and a trade deficit. They don't have a giant pile of extra dollars sitting around to invest. Unlike China in the 2000s, which was earning billions every month from selling manufactured goods to the world, the UK is actually a net debtor. So when you see them suddenly holding nearly $900 billion in American debt, you have to ask who's really doing the buying. Protocol Rule 3, the gold hedge. Look at the trade one more time. China sold bonds and bought gold. Hedge funds borrowed cash and bought bonds. China is holding the hard asset. Hedge funds are holding paper wrapped in more paper, debt on top of debt. In a crisis event, paper assets face pressure while hard assets tend to outperform. Align your long-term savings with the entity buying the hard asset, the sovereign, not the entity arbitraging spreads. Accumulate physical gold. When the basis trade unwinds, central banks intervene with liquidity injections. Those injections devalue currency and typically send gold higher. Gold has no counterparty risk. It doesn't depend on the repo market to function. Let the hedge funds pick up pennies in front of the steamroller. You stand on the sidewalk holding gold. The United States didn't solve the China problem. They managed it temporarily. The data suggests they moved nearly 700 billion of supply into the Cayman Islands and the City of London. The debt still exists. It hasn't vanished. But now it's held by entities that will sell at the first sign of real trouble. The system is more fragile today than when China held the debt. The buffer is gone. The leverage is extreme. Navigate carefully. If this video opened your eyes to what's really happening in the Treasury market, do me a favor. Subscribe to Capital Pressure if you haven't already. Share this with someone who needs to understand these risks. Leave a comment with your thoughts on where this is headed. The engagement helps us reach more people who need this information. I'll see you in the next one, where we dig even deeper into the financial pressure points that matter. Stay sharp out there.